Okay. Good afternoon to all of you. On behalf of the Accounting Standards Board, it's my privilege to welcome you all to today's webinar on a subject of considerable importance in financial reporting, Ind AS 105, Essentials, Classification, Measurement and Presentation. The accounting treatment for assets held for sale and discontinued operations is governed by Ind AS 105, which provides a clear framework for the classification, measurement, and presentation of non-current assets that an entity intends to recover primarily through sale rather than through continuing use. The standard plays a critical role in ensuring that such assets and operations are appropriately reflected in the financial statements, thereby enhancing the transparency and usefulness of financial information for stakeholders. From an accounting and reporting perspective, Ind AS 105 requires entities to carefully evaluate whether the criteria for classification as held for sale are met, including the availability for the asset for immediate sale and high probability of completion of the sale within a stipulated time frame. Through today's session, we aim to provide participants with a clear and practical understanding of the key principles of Ind AS 105, focusing on its classification criteria, measurement requirements, and presentation framework in financial statements. We are confident that this webinar will provide valuable insights into the practical application of the standard and will support professionals in ensuring accurate, transparent, and high quality financial reporting. We thank you for joining us and look forward to an insightful and engaging discussion. We are privileged to extend a very warm welcome to our esteemed speaker for today's webinar, CA Vinod Balachandran sir. Before we move into the technical discussion, it's my privilege to introduce the moderator for today's webinar, CA Bhavesh Gondia sir. CA Bhavesh Gondia is a practicing chartered accountant with more than 14 years of diverse experience in audit, assurance, and financial reporting. He is also a certified concurrent auditor and peer reviewer with ICAI and has handled statutory, concurrent, and stock audits for PSUs and private banks. He has been a corporate trainer and faculty for IFRS or Ind AS and has delivered customized sessions for corporates and conducted ICI's post-qualification certification course on Ind AS. Over to you, sir. Bhavesh, sir.
Thank you, CA Rahul Navani, sir. Respected dignitaries, distinguished speakers, and dear participants, a very good afternoon to everyone. On behalf of the Institute of Chartered Accountants of India, I warmly welcome all of you to today's insightful webinar on Ind AS 105 Essential, that is classification, measurement, and presentation. In the dynamic corporate environment, business constantly restructure the operations. They divest assets, discontinue segments. So in such a situation, that accurate classification, measurement, and transparent presentation becomes extremely important to ensure that the financial statement reflects the true economic substance. So today's session will help us understanding these terminologies, that when an asset should be classified as held for sale, how such assets should be measured and presented into the financial statements. Before we proceed further, I would like to share a small thought that financial reporting is not merely about numbers. It is about telling the true economic story of an entity. Let me repeat this. The financial reporting is not merely about reporting numbers, but it is about telling the true economic story of an entity. And standard like Ind AS 105 would also highlight that economic story about what the organization is planning to do. So today's topic of Ind AS 105 is highly relevant for chartered accountants, auditors, finance professionals, corporate accountants, and regulators. Now, it gives me an immense pleasure to introduce our esteemed speaker for today's session, CA Vinod Balachandran Sarji. CA Vinod sir is a fellow chartered accountant and insolvency professional with over 30 years of rich experience, spanning global corporate leadership and professional practice. During his corporate career, he held key positions including CFO and head of finance across India, Qatar, and Dubai. with reputed organizations such as Alphabet Group and Indian Hotels of Tata Group. He is actively associated with the Accounting Standard Board of ICI as a faculty for Indes, contributing to professional capacity building and training of finance professionals and government officers. His professional credentials includes ACIS London IFRS certification from ACCA, DISA from ICI, and a management development program from IIM Bangalore. We are extremely fortunate to have such an experienced professional with us today to guide us through the intricacies of Indes 105. CA Vinod sir, we are truly grateful for your time and valuable presence. I now request you to kindly take over the session and enlighten us on Indes 105 essentials, which are classification, measurement, and presentation. Over to you, Vinod sir.
Thank you, sir. Thank you very much. This Indes 105 is actually one of the most interesting Indes of all. It looks very small and very basic, but we have observed that a lot of errors come in its application because this Indes is a bit open-ended. You need a bit of experience to understand it and a bit of experience to know how to disclose, when to disclose, etc. In corporate finance, this index is the most sought after because companies need to know, or the readers of the financial statements need to know, is there something planned for sale? If something is sold, what happens to my balance sheet? What happens to my ratios? Will I have a problem with the bank? Will I be giving too much information outside? Will I be subject to more scrutiny? Because this index is all about telling the world what you are holding for sale. Now, normally these kind of sales transactions, or those kinds of company professional transactions are kept secret. So you're not supposed to go and tell to the whole world that I'm selling my thing for a 30% margin, etc. But this index probes you and says that if you have a committed sales contract, then you better disclose it correctly in the annual report. You can't hide it. In our old accounting standard, we did not have such a standard. We only had a standard for discontinuing operations. So this is held for sale and discontinuing operation. This is something new for users, those who are new to IFRS, or for those people who are new to the India's financial statements. This is something new. So you have two things: holding something for sale and then discontinuing operations. One has a balance sheet impact, the other has a profit and loss account impact. Sometimes either of the one has an impact on both sides. If it is an held for sale, it is a discontinuing operation. Sometimes if it's a discontinuing operation, it's a held for sale. Sometimes it is not both. Maybe it is only a held for sale and not a discontinued, vice versa. So this standard requires a bit of thought and a bit of experience, and it is very relevant at higher levels of finance and at board level, where you are supposed to disclose certain things. So you have to have a lot of care and diligence while we report these kinds of figures. So to make it a bit interesting, we will do a presentation type discussion today, so that it will be more sensible for those who are seeing it, instead of me just talking all the time. So this standard is named 105, non-current assets held for sale and discontinuing operations. This is a large name, non-current assets. So basically it is telling us this is only relevant for non-current portion and not necessarily for current portion. That's what it sounds like. but it is not necessarily true. Let us try to understand what it is trying to do, the first part. So we are dealing with non-current assets held for sale. So we are dealing with the first part of this index. Just a second. I'll just share it. Is the sharing visible?
No, sir, the screen is not
Now
visible.
not visible. Earlier it was there, sir.
Yeah, I think the screen just went off. Just a second.
Just share
Just
it
a
one
minute.
second, sir.
Yeah, I'm just sharing it. Yeah, I think it's come now.
Yeah,
I
now
hope
is
is it visible? Okay,
yeah, now
sorry for
visible,
the
sir.
yeah. Sorry. Okay. So we are dealing with the first part, which is non-current assets held for sale. So if you look at this chart, it has got three parts. First part is non-current assets, meaning it will only include the non-current asset portion of the balance sheet. Current assets are excluded. The second part talks about disposal groups, meaning you may want to sell not an asset, maybe you may want to sell your company, or you may want to sell a big factory, several assets put together. In this part, current asset, non-current assets, current liability, non-current liability, all will come. And the third part is called non-current assets distributed to owners. That is a sounds a bit strange. What are these assets which are being distributed to owners? So we will have a look at all three. So we have to remember that we are dealing now with the first part of 105, non-current assets held for sale. Now that has got three parts. One, you may want to sell only an asset, maybe one machinery, you want to sell a large machinery is there, or one piece of land you want to sell. You have one land in your balance sheet you want to sell, or a building you want to sell. There is a sale deal. So it's a non-current asset held for sale. Second part is you may want to sell entire North Indian operations to somebody, or you may want to sell your entire factory in Dubai to somebody. So when you are selling a factory or a cash generating unit, you will have assets, liabilities, loans taken for that, etc. So it will be a net assets value. So in the disposal group, second part, the heading of this India is non-current asset technically doesn't apply because their non-current and current assets all comes in because you're selling it as a group. Measurement conditions but are different. We will come to that. Distribution to owners. What exactly does it mean? Assume that maybe I have a subsidiary company and I own 100% of a subsidiary, and I have decided that subsidiary shares are going to be distributed to my company's shareholders. A Limited share. A Limited owns S Limited. So S Limited shares are going to be distributed to A Limited's shareholders. This is called distribution to owners. This also happens, but not in that much frequency. So this is the first part of Ind AS 105. Now we will try to get into details of this. What exactly is all these things? Now the definition of a disposal group, what is mentioned, you can go through. A disposal group means a CGU, cash generating unit, or something large, geographical, or a factory, or a profit and loss unit, or something large which contains assets. Maybe there's a loan to it, so there could be net assets. There could be current inventory in that. Current assets would be there. Loans and advances could be there. Investments could be there. So there could be a lot of items in a cash generating unit. So the entire CGU you want to sell. That is what is called a disposal unit. Well, for distribution to owners, we discussed. If a parent wants to distribute the shares in its subsidiary to parents' shareholders, that's an example of distribution to owners. So three things come in this first part of this Ind AS. Now, since the heading says non-current assets held for sale, largely this Ind AS deals with the main non-current assets, PPE, CWIP, intangible, goodwill, investment property. These are the main large items in your balance sheet, which basically you may want to sell. In addition to this, in the balance sheet, there will be financial assets like investments, loans, etc. But that is scoped out from this Ind AS because that comes under Ind AS 109. So the difficult part in understanding Ind AS 105 is that in a disposal group, you will be selling all kinds of non-current, current assets, liability, etc., which includes non-current assets and which includes current assets and financial assets, and many assets which doesn't come under this 105. So if you look at what is scoped out of this, income taxes, employee benefit, financial instruments, agriculture, insurance contracts, these are all coming under other Ind AS. So what we need to understand is that when I'm selling a disposal group or a CGU, whenever I have to deal with financial asset or any of these scoped out items, I must use the valuation or the measurement as per those Ind AS and not as per Ind AS 105. Scoped out items are included in disposal group but are measured under those particular Ind AS. Only these major Ind AS items or these items in the balance sheet are technically covered by the measurement standards of this 105. This is the first confusion we have to clear in our mind. Disposal groups includes all kinds of assets and liabilities, but for measurement purposes, only these main items we will use Ind AS 105 for measurement. Rest of the Ind AS or rest of the items of belonging to other Ind AS will be measured as per the measurement principles of those Ind AS. So this we have to just keep in mind. Wherever disposal groups are coming in, there could be a bit of confusion. Slowly, I think once we go through this, we can largely clear out most of our data. Some definitions again. Since this is held for sale, that means definitely there will be certain costs involved in the sale. So disposal costs. It's nothing new for us to discuss. So just to keep in mind, it will keep on asking a cost to dispose. So disposal cost will exclude finance cost and income tax, only direct cost. Now, what we mean by this held for sale is a simple balance sheet. If you look at this balance sheet, you will realize that these are all non-current portion. So when you are doing 105 specific asset sales, you only take the non-current portion. Now, if you're dealing with disposal groups, if the CGU based in Mumbai, I'm selling a factory in Mumbai, the factory would also have non-current assets and current assets, less current liabilities. So there'll be net assets in the factory. So disposal group means you will consider items outside this Ind AS also. So the non-current classification is key here because this name of the Ind AS itself is non-current assets held for sale. So the purpose of this Ind AS is to basically ensure that any non-current assets held for sale are disclosed separately in the balance sheet below current assets. So after non-current assets, current assets, below that you will have a line classified as held for sale. Here also you have another one, because there might be the items what you're selling, there could be certain impact relating to minority interest. We call it non-controlling interest in Ind AS. So maybe that is lying in reserves and surplus in the equity. So that also might need to be separately disclosed. If you come to the asset side, the liability side, the liabilities related to disposal groups. Maybe there is a loan given for that particular disposal group being sold off or asset being sold off. So if you look at it, the idea behind this Ind AS is, if you plan non-current assets held for sale or a disposal group or a distribution to owner, you have to separately disclose it in the balance sheet. This is the core concept or learning behind this standard. We will go through in detail. This is just for us to understand, so that when we pick up the standard, we are clear on what we are trying to do. Held for sale. Held for sale means there are certain conditions to follow. The asset must be ready for sale in present condition. The chances of the sale must be highly probable. You cannot just regroup your balance sheet and say it is for sale when you have done nothing to sell it. There must be paperwork, there must be board resolutions, there must be tenders raised, parties identified. There must be a process going through it. So if the asset is not ready to be sold, you cannot put it under this classification. So this standard is applied when you propose to sell an asset instead of using it in operation. There are 5 principles for this held for sale, which needs to be understood. And this is where I said in the beginning that the application of the standard requires some experience at a corporate level. Understand what is the intention of this company. Are they just window dressing it? Or is a sale really going to happen? Or are they serious about the sale? Etc. So let's have a look at these 5 conditions. 1, commitment of the management to sell. The board of directors should pass a resolution in this regard. There must be tenders issued, buyers identified. 3, the pricing you are expecting should not be out of the market. That is, it should not be impossible to sell. An item worth fair value 100, if you are saying I will wait for it fair value to be 1000, then there is really not an intention to sell. It is just wishful thinking to make a profit. Now, the most important condition is here, the 1-year rule. The sale must be completed within 1 year of passing the board resolution, meaning within 1 year of disclosing in the balance sheet as held for sale, you must complete that sale. That 1 year is sacrosanct. That's the most important thing here. Lastly, there must be almost negligible chances that the board of directors would change the decision. Every sale cannot happen. Now we have a war going on. Maybe because of the war, a lot of sales might be stopped. It's a classic example. What happened to Ind AS 105 in the Middle East region for all those accounts which showed held for sale? They were planning to sell it in April, but now you see war has broken out. Force majeure. So is 105 affected? That is the rule. So maybe because of the war, the buyer would say, let us conclude the transaction somewhere in May or June, by the time this war would finish. So by the time it is May or June, 1 year period would have passed breaking this condition. So now we will come to those rules on this 1 year. What happens in between, things like war or some other issues come in, which disturbs this contract to sell? Few examples before we come to the confusion of whether 1 year is broken or not. A property being used as the HO needs to be vacated before it can be sold. So, board of directors want to sell the head office, but there is a rule. We have to vacate out of the office, then only buyer can inspect and buy. The time required to vacate the building is usual and customary. So it's not a big thing. So what it says is that minor administrative issues like we all have to move out of the building for the buyer to take possession. Now that can be done in a month's time. So it doesn't affect the 1 year rule. So minor items impacting the sale you should overlook, because in a business it might be quite difficult to get an asset perfectly ready for sale. There will always be some activity going on, some license pending, some paper to get, some tax to pay. So we should be able to I understand that minor things should not affect our disclosure. Now, in this same example, if the property can be vacated only after replacement is available. Imagine I'm in Mumbai, I want to be in the Fort side, but there is no building available. So I know very well that it's impossible for me to shift to a new building so that I can vacate my own building, but there's no alternate space available, or the alternate space might be available only after 4 months or 5 months. In such a situation, this building is not held for sale, cannot be held for sale because it is not in a saleable condition. To be saleable, the occupants have to move out to a new building, settle down there, move their servers. It will take few months. First, look at the second condition. A manufacturing facility, I want to put it as held for sale, but there is a large uncompleted order. So unless the orders are completed, it is not ready for sale. But if the buyer is saying, okay, I am buying your company along with work in progress or uncompleted orders, then it can be held for sale. Renovation. This is the classic example which always comes to building. Building needs to be renovated for held for sale. Directors want to sell. Renovation will take 3 months or 6 months. What do you do? So technically building is not ready. So you may need to renovate it first and then say it is held for sale. But if the renovation is minor and it's going to take maybe a few weeks, minor thing which doesn't affect the buyer, then you can treat it as held for sale. Mostly people do renovation so that the value of the building goes up. Look at the fourth item. A company has put a property on the market and expects that all conditions of classification as held for sale are met. Any buyer will undertake searches and valuations before making an offer and exchanging contracts. Such conditions are normal for properties. Any delays in legal processes do not affect this classification. Because after I put it in market, it is normal that certain paper I have to get from municipality or corporation, certain things. These are all minor things. So those things should not affect our Ind AS 105 classification. Minor pre-selling activities. As we discussed, minor things should not affect our held for sale classification. This is in real life as a CFO or as a board of director. This is one area which you will find challenging, that something or other is pending. Some paperwork, some license. Maybe asset needs polishing, painting, asset needs some annual maintenance. Now, you are aware we have the LPG issue in India now because of the Gulf Iran issue. The reason is Qatar Gas, which exports the maximum gas in the whole world, LPG, they close their plant. Now, if you close a gas plant and you want to now open it again, it takes minimum 1 to 2 months. The shutdown and open procedures are very complicated engineering and you need to invest huge amount of money. So assume you're selling that gas plant now as held for sale. So technically you cannot say it's held for sale. The plant has to be switched on, all the maintenance has to be done, plant needs to be put back into operation capacity. So this is something how you need to understand whether an asset is ready for immediate sale or not. It is very difficult. There is no straight, clear examples to tell you yes or no. Absolutely no examples to tell you yes or no. Now, look at the main two examples, if what we discussed. If renovations are needed so that the property value goes up and then the property is ready, then it is not held for sale until the time renovation is complete. Now, the second one, if you see, buyer has to vacate the building. That's a minor process. So it doesn't affect the held for sale. So in real life, you might need to, as an auditor or as a CFO, you might need to really look at the circumstances to decide, are you really falling under held for sale or are you breaking that condition? It's not a very straightjacket answer of yes and no. We have to look at all the conditions and form an opinion. Then you have these conditions of assets purchased for disposal. In that case, what happens? The directors know that I am buying a building. I don't have any use of that building. My plan is I know that rates are going up in North Mumbai, for example. So I need to make sure I'm available there to enjoy the arbitrage profits. In such a situation, what happens? I'm buying it with the intention to sell. But the property I'm buying is not necessarily new. Take the example of a car. I'm buying a Rolls Royce car or 5-year-old Rolls Royce car because I know that there's a lot of people who are interested in buying good cars. But since the car is 5 years old, I might need to spruce it up a bit. Maybe, interior, maybe spend 10, 20 lakhs on sprucing up the look and the feel. Then only I'll get the value for the Rolls Royce. But my intention is not to use the car. I am in the business of buying and selling. So I have purchased the asset with the idea of disposing it. In such a case, even though it is not necessarily ready for sale, 105 conditions are met and you can disclose it as held for sale. The difference between what we discussed till now was the assets what I have, I want to sell. It was never purchased with the idea of disposing. Now we come to the condition. If I buy something with the resolution itself states that my idea of buying it is to sell. I have no intention to use it and make money out of my own operations usage. I'm an arbitration trader, you can call it. So if my intention is such that I can take the call that the asset need not be 100% ready for sale. I might need to do a bit of maintenance, cleaning up something, sprucing it up, etc. From the beginning itself, I can put it in the balance sheet as assets held for sale. So very, very important classification. Because in many companies, this minor definition people forget. And what they do, assets which they are buying for, which is originally for sale, they depreciate it. What are the exceptions to this 1 year rule? As we discussed, whatever assets you are holding for sale, you need to make sure it is completed within 1 year. That 1 year is sacrosanct, very important. But some leeway is given. What are the exceptions? The delay must have been caused by events or circumstances which are beyond the control of the entity. Something like what's happening in the Middle East now, force majeure. There is a war happening. I can't do a thing. Buyer is ready, seller is ready, building is ready for sale, everything. But I can't conclude the transaction now because of war. So maybe the 1 year period might extend to 3 months, 6 months. A lot of movies which were supposed to release in March, now you have seen that they have all postponed it to June, July, because nobody wants to release a movie in a war. Something like that. These are exception to 1 year rule, things beyond your control. You really can't do anything. And there must be sufficient evidence that the directors or the company is committed to that plan. I have decided to sell. I have a memorandum of understanding with the buyer, but then the war came. So buyer is telling me wait 6 months. After 6 months, we will conclude the transaction. So that 6 months is going to come 1 year later, maybe. That 1 year period might exceed. So the directors can take a call here saying that this is beyond our circumstances. We are ready to sell. Everything is ready, but something outside is blocking the sale to happen. So this is a slightly gray area. Things can go up and down. We have to be very careful here. When we learn the measurement principles of the standard, then we will know why it is so important, this classification of held for sale. Some examples of this 1 year rule. An entity is committed to its selling plan of a manufacturing facility. After a firm purchase commitment, the buyer's inspection identifies some environmental issues. The entity is required by the buyer to correct those environmental damages or some pollution issues, etc. The entity has initiated actions to make sure it is corrected. It will take some time. So this is a good example of exception to the 1 year rule. Just like war, environmental factors, political factors, like now election season. Elections are coming. So difficult to get a government. I need to get a piece of paper from government NOC. Now they are saying that, okay, only after new government comes, we can issue the NOC. So that's an exception to the 1 year rule. So these things we have to keep in mind. Second one, mining industry is a disposal group. I want to sell off a mine in Mozambique. Sale requires regulatory approval. Now, you know, regulatory approval can take more than 1 year. Courts are crowded. Politicians are there. It's not easy. So in these kinds of situations, you can take a call that the 1 year exception can be claimed. But please note, this is also a case where the Ind AS 105 can be manipulated. You know that this regulatory approval you will never get because you have a serious pollution problem, or you are built next to a river where government forbids you from constructing near the river. But factory is near the river, never in life you are going to get approval. So those kinds of situations is never held for sale. The approvals you are supposed to get, regulatory clearances, environment, that must be possible. Now, impossible approvals and regulations cannot allow held for sale classification. So as auditor or CFO or consultant, this is an area where we have to approach very cautiously and make sure that you have to complete the held for sale within a year. Exceptions to 1 year, you have to be very careful. You have to wait line by line and see whether it is a general exception, specific, regulatory, whether these are possible. As a company has the resources to correct it and get all the permissions in order within a short period of time. Many factors are there. So there is no straight answer to whether held for sale, saleable condition, and the 1 year within which you are supposed to sell this item. There is always a bit of leeway. we have to be careful and use a lot of experience and industry knowledge to ensure that you are in compliance of 105 held for sale conditions. In some cases, instead of held for sale, many companies abandon assets. For example, there is a war going on. I ran away from that country. Telecom towers. Telecom towers put in a war area or in a terrorist area where the telecom company cannot enter that area. They will be killed if they enter that area. So that area has been captured by militia. And they have threatened saying that anybody who comes here is killed. So the telecom company has to abandon the asset. It happens in many cases. In India, it is less, but in other parts of the world, this is very common that you abandon or you run away because of many issues. Abandonment is not held for sale. That is something we have to keep in mind. Many companies, when they abandon because of some, you have seen ships being abandoned. There is a chemical leak from a ship, or the ship has hit something and all the cargo is all nuclear waste. Nobody will touch that ship. So you have to abandon that ship. Now, abandonment means it is not held for sale. Abandonment means it can be discontinued operation. It may be. It is not held for sale. So please be careful. When you abandon something, you cannot put it as held for sale. Now that we have understood that what are we trying to do? Wherever we have non-current assets held for sale, or we have a disposal group, or we want to distribute assets to owners, then there are three conditions. And you have a asset is in saleable condition, and the sale can be concluded within 1 year. If all these conditions are met, you can regroup all those assets into one line in the balance sheet as held for sale. Now, what's the implication of doing it? The most important thing. Now we are coming into the measurement part. The implication of held for sale. First implication. You will account as held for sale at its book value, means whatever is already in the accounts, that value, or its fair value less cost to dispose. Maybe book value was very high. I purchased this asset maybe 3 years back when servers or IT equipments were costing 10 crores. Today, the same technology, the 10 crore equipment is, I can get in market at 2 crore. So 10 crore is my book carrying value, while the same equipment is available at 2 crore in the market. So when I regroup that computer or server, which I'm planning to sell from PPE to held for sale, I will regroup it at 2 crores only, and the 8 crore difference I will write off as impairment loss. So the valuation in held for sale is book value or fair value less cost to dispose, whichever is less. And the implication, I have to stop depreciation and amortization. If I'm holding it for sale, what basically the measurement says is that if there is a contract that I am going to get 1 crore rupees for sale of a group of my factory in Dubai, I'm selling, I'll get 1 crore rupees. In the balance sheet, held for sale, I will show it at 1 crore, whatever is the sale price I'm going to get. Whatever is book value, carrying value, I don't care now, because I have an agreement with the buyer that within 3 months he will give me money and I'm going to sell it to him, 1 crore. So this is the implication. You move the assets you are planning to sell to a separate line in balance sheet and account it at fair value, which is largely the transaction cost or the agreement, sale agreement cost, less cost of disposal. So when you do that, you have to stop depreciation and amortization. So there's a huge savings in your P&L. Now this is where we have to be careful that misuse can happen. I can abandon assets, and if I put it in held for sale, I can avoid depreciation and inflate my profit. But what we discussed, abandonment is not held for sale. Same way, I can strike up a dummy agreement and say it's a held for sale, stop depreciation, pick up my profits, show higher profits, increase stock market price. So these kind of manipulations can happen. Hence, we have to be very, very careful. Wherever there's a held for sale, we have to make sure that we follow all the conditions. Management is committed, board of directors resolution, there is a buyer, there is a contract, tenders are raised, action is going on for selling, asset is in saleable condition, and the sale will happen within a year. All these conditions. Hence, more tact and more understanding is required, because moment you put it in held for sale, depreciation or amortization will stop. So that's the danger part. So you are going to issue an accounts where bulk of your assets, which is going to be sold, is no longer depreciated or amortized. So the implications are very large for large held for sale transfers. Now, you have in India, we have accounts as of 31st March or every quarter. Now, the board of directors have taken a decision on 31st May or 1st June that one particular asset we have a contract to buy within 1 year is going to be sold, a large plant and machinery. I'm going to sell for 1 crore, or within 4 or 5 months, sale is going to happen. So on 1st June of this year, I have got the clearance for accounting that machine as non-current asset held for sale. Now in my books, I have depreciated, I do depreciation every quarter only for quarterly closing. So the book value in the books is as of 31st March 2026. Held for sale decision taken on 1st June 2026. So this slide tells you that just before you do the measurement principles of 105, make sure rest of the accounting is all complete, meaning April and May, 2 more months of depreciation you provide, bring the asset to 1st June book value. That's what it says. Carrying amount of all assets and liability in the group shall be measured as per Ind AS. In case the held for sale is not in a reporting date, quarterly date, in case it is in a in-between date. Every quarter, anyway, we pass all the entries to the quarterly. In case you are doing between quarters, please make sure all the provision, prepaid, depreciation, all the entries are passed, the valuations are done as per the respective Ind AS, fair values are found out, etc. Keep the accounts ready. Once the accounts are ready, there will be scoped out items like financial assets, current asset, current liability. Those are not in 105, but it is part of a disposal group like a CGU, the full factory and sale. So all those assets which are not under the 105 Ind AS, make sure it is valued as per the respective Ind AS. Some things has to be fair value, take the fair value. That's what it says. Now in business combinations, as you are aware, when I am buying a subsidiary, anything more than 50%, in the CFS, the parent company accounts for the subsidiary's assets at fair value, not in the SFS. All subsidiary assets are at fair value in the CFS. But if that subsidiary is being purchased for future sale, or if there are some assets in the subsidiary which you are going to put as held for use, non-current asset held for sale, then the valuation also should change as per 105. It should not be as per Ind AS 103. In 103, it says you have to account it at fair value. Because these acquisition of subsidiaries done for sale within 3 months or 4 months, or one of the assets in the acquisition is going to be sold within few months. It's satisfied held for sale conditions. Instead of fair value, you must value it at fair value less cost to dispose. So what it is trying to say is that 1015 will override regular Ind AS sometimes. A simple example of how this accounting can happen. Have a look. The difference between fair value or book value, whichever is less, is treated as impairment loss. So there is impairment loss as per Ind AS 105. But we also have Ind AS 36 impairment. That anyway happens for all the assets. So you might have two types of impairment in the books of account, 105 impairment and Ind AS 36 impairment. The below part, goodwill, etc., we'll go to the next slide and we will learn. Now we will have slightly revised conditions of impairment, how impairment loss is accounted, what happens if an impairment is reversed. Because there's a time for sale is 1 year. In this quarter, fair value is down because of war. In the June quarter, war is over, stock markets picked up, fair value has shot up. So what happens? The impairment loss under 105 booked in this quarter might become impairment gain in the next quarter. Till the time you sell, it keeps on going up and down, fair value accounting. So what are we supposed to do? That is the next step what we are going to learn. Sorry, before this, we will just do 2 slides and then we will do that. This is now we are going to Ind AS 36 to just revisit what happens when you impair. The conditions of impairment loss is that the impairment loss should be first set off against goodwill. After that, impairment loss should be set off against all the PPE, all the non-current assets, pro rata. So if there is a goodwill, first knock it off. Then proportionately assign impairment loss to the non-current assets. That's the rule of Ind AS 36. We have to remember. Subsequently, in the next quarter, if it becomes impairment gain, you can reverse those impairment losses, but losses allocated to goodwill you cannot touch. So these are Ind AS 36 conditions we must remember. Impairment losses are first allocated to goodwill, but later on, if it becomes impairment gain, do not reverse the losses allocated to goodwill. But the losses allocated to the asset, you can reverse back, subject to the condition that it does not exceed the original carrying values less depreciation. So this rule we have to remember under impairment loss. Losses first allocate to goodwill, then to other assets. Impairment gain, reverse those losses. Do not touch goodwill when you reverse impairment loss. But you can reverse the losses already allocated to the other PPE to the extent of their carrying values. Because if the carrying values with the regular depreciation is maybe 100, because of impairment gain, you are allocating it to the asset. So the asset's carrying value might increase from 100 to maybe 120 if it's a land. So that is technically revaluation. That's why it says you have to be careful here. While you reverse impairment losses, you have to be careful. So let's take a typical example of 105, how these losses will come and how it is allocated. This example is a very basic, simple example, but it will give you a very good idea of how to understand 105. So let's take a call. Look at this. The first column is book values. This company, we are planning to dispose of a group, maybe a factory in Maharashtra. Okay. We want to sell a factory in Maharashtra for which there is a intention to sell, there is a contract, there is a buyer, sale will happen in few months. Today, on March 31st, there is some figures. In October, directors have decided that, okay, let us do held for sale because the sale transaction is almost genuinely confirmed. So between March to October, there's nearly 7 months. So in March, so many assets are there which I am going to sell. Goodwill, PPE, intangible, inventory, investments. Now, if you look at it, inventory and investments are not non-current assets. These are financial assets and one is a inventory. But it is part of a disposal group. So you have non-current assets as well as current assets all bunched together, which I am planning to sell. The value in March is 3350. The fair value in October, that is the day when I decided to have a held for sale classification, is 3250. So there is a depreciation, or what you can call it, fair value changes up to October is 100 rupees. Because we are doing closing only yearly. So 31st March, my disposal group value is 3350. 31st October, my disposal group value is 3250. This is 31st October. Because every quarter I will do fair valuation, depreciation, amortization, etc. So the fair value, the book value of the disposal group is 3250. On 31st March, I appoint a valuer who has done a valuation of this disposal group, and he says that, sorry, you will only get 2,600. So there is a 650 rupees impairment loss. Because on October, what I will do, all these assets, goodwill, PPE, intangible, inventory, investments, all this I will bunch together and put it in one line in my balance sheet as assets held for sale. Depreciation stops from October 2025. But in October 2025, 650 rupees of impairment is happening because the valuer says that your book value is too high, you will not get that much. It is only 2,600 value. So the 650 rupees, I have to pass a journal entry, debit impairment loss and credit all these assets for 650 rupees. So the order of credit, you will see that first you knock out entire goodwill. There was a 400 rupees goodwill, so entire amount I knock off goodwill, 400. Second, I have two non-current assets, PPE and intangible. On a pro rata basis, I allocate the losses to PPE and intangible. Inventory is scoped out of the standard, so I ignore because I have a fair value of inventory there. Investment scoped out of the standard, I ignore. So that is also at fair value, 380 rupees. So if you look at it, on the day held for sale journal entry is passed, 650 rupees of 105 impairment has been accounted, debited to P&L and credited to first to goodwill and then to the other asset pro rata. Now, assume after 1 quarter, the war is over, the fair value now becomes very high. I have 1,000 rupees gain. So currently 650 rupees of impairment loss is there in P&L. Now I have 1,000 rupee gain. So what the standard says, to the extent of losses which was already debited to P&L, that much I can reverse. That's it. I cannot reverse the entire gain of 1,000 because only losses which was previously debited can be reversed. Otherwise, it will be revaluation accounting. Under Ind AS, you know that revaluation gains and losses will only go to OCI and never to P&L. So that is reversal of impairment loss. That basically comes under Ind AS 36. But when you do 105 accounting, you will also face impairment loss reversals when market is doing good. So just for basic understanding, disposal group will have non-current assets as well as current assets and liabilities. Current asset and liability value as per that whatever Ind AS is there. Impairment losses, first clean out goodwill, then apportion it to non-current assets. Impairment gains restrict to the extent of impairment loss. These are the principles to be followed for 105 accounting. Impairment gains we discussed, it will be restricted to the cumulative impairment loss. You cannot do more gain than loss already debited. Now, when you are moving non-current assets and showing it in a separate line in balance sheet as held for sale, do you need to regroup previous year? No. So you will only have one side entry. Previous year will be left as it is. These assets will be in their own respective non-current assets. It's a very, very important rule. Now the next question, the last question in this held for sale. What happens if sale doesn't happen? Now, as we discussed, there is a Gulf War going on. There's a big fight. Now, because of the war, absolute destruction has happened. Value is eroded. I decide there is no point investing in Middle East now because maybe one more war can come, something can come. I am a bit afraid to invest there. So what do I do? The board of directors take a decision officially saying that we have now decided to reverse held for sale. It is allowed because this is business. Sometimes it doesn't happen, the contracts are cut, war can happen, force majeure situation will happen. So what do you do when a held for sale has to be reversed? So from held for sale, you have to put it back to the original non-current assets, current assets, financial, like that. Go back to original. So the accounting also, you have to go back to original as if held for sale never happened. So depreciation, amortization and all, go back to your building board before held for sale accounting, continue as if held for sale never happened. That is what you have to do. We will do an example of that. So instead of talking, that will be more sensible. Have a look at this. Property is purchased in year 1 for 6 lakhs. Property has a life of 15 years. After 2 years, that is in the 13th year, in the second year, the director decided that held for sale definition has to be used because there is a buyer for this PPE. So on that day, the carrying amount is 4,70,000, while the fair value is 4,60,000. On the day held for sale decision was taken, this is my carrying value and fair value. So from this itself, we know that on X3 year or the second year, I have to account for this held for sale at the lower of carrying value or fair value. So here in this case, 4,60,000 is the amount I have to show as held for sale asset. Now, after nearly a year, the directors are saying that no, we are reversing the decision, and now same asset, the recoverable amount is 5 lakhs. So I have a gain now. So initially there was a loss, now I have a gain. So just remember these figures. In the next slide, we will see how these figures work out so that we will have a good understanding of what is held for sale workings. So 4,70,000 was a figure which was already given in the question. Carrying value. Fair value is 4,60,000. That means there is a 10,000 rupees of impairment. In addition, we have a impairment loss of 50,000. Depreciation. This is just regular working. So just for you to remember, on this right side, what has been debited to P&L in the year of held for sale is there is a depreciation of the machine of 40,000. There is an impairment of 50,000 plus additional 105 impairment of 10,000, making it 60. So totally 1 lakh rupees I have debited to P&L. In the year, I reclassified assets to held for sale. Just for understanding, 1 lakh was debited as 60,000 impairment loss, 40,000 depreciation in my P&L. Subsequently, I have realized that I'm not going to sell. And I have a recoverable value of 5 lakhs. So when I decide that I will not sell a held for sale asset, what I have to do? I have to ignore the held for sale accounting and go back to my original PPE accounting, gross block depreciation, recalculate and come to today. This simple Excel only, no need to bother about the figures. So net, we will have a 26,000 charge to P&L. If I had not done Ind AS 105, the asset would have been 4,60,000 value in my books. Now, because of depreciation, etc., the value is 4,33,000. So 26,000 rupees charging into P&L. Just reworking the depreciation schedule, nothing major. Just for us to know how you have to recalculate depreciation or amortization if sale doesn't happen. Go back to drawing board. Assume you did not do held for sale accounting. Go back to depreciation and do useful lives and come back to today's figure. Difference go to P&L. Very simple. Have a look slowly, spend a minute or so. Now, accounting policy note. Now you know we have to write material accounting policy note in the annual report for held for sale. From one of the listed companies, I have just pasted a nicely written accounting note. Just have a look at it. It just gives you a fair idea of how you have to do disclosure note for held for sale. It is writing all these conditions, what we discuss, the management's commitment, within 1 year it should be complete. Valuation is at cost or recoverable value, whichever is fair value, whichever is less. The 5 points of ensuring that sale will happen. Tenders are there, documentation is there, buyer is identified. So many things. Further, it says PPE and intangible, once classified as held for sale, will no longer be depreciated or amortized. The last part is for discontinuing operation that we'll take up next. So basically, you have to write the policy clearly, how you identified held for sale, what are the conditions you are using, what is the measurement principles you are doing. Now, how the balance sheet comes in, you can have a look. After the current assets, you look at it, assets classified for as held for sale is disclosed. So you have non-current asset, current assets, then asset classified as held for sale. Separately, you have to disclose. Same thing in the liability side also. You will see here below current liabilities. Liabilities classified as liabilities relating to those assets held for sale. Maybe there is a bank loan for that asset or the disposal group, some gratuity payable, something, anything. The disclosure is quite simple. Separately, below the current asset or liabilities, you have to disclose held for sale, liabilities and held for sale assets. Then you need to give in the notes the split up of all the assets totaling to your disposal group. So this will include non-current assets, current assets, liabilities, anything. So just have a look at it. In this case, there is land, plant and equipment, investments at OCI, investments at cost, loans, work in progress, others. Then you have liabilities of discontinue of the held for sale. So you have to separately list out the total of the disposal group, the column which goes to the balance sheet. You have to give the split up between asset, liabilities, financial assets, scoped out assets, entire thing. So that the reader of accounts can know that these are all the things which has gone to the balance sheet. Then this is a net assets, all charts put together. Assets less liabilities, the net assets of the held for sale. Same thing, what we saw. Just gives a one page snapshot of all the items listed out in days wise, giving you the figure of held for sale. Same thing you have to do for cash flow also. You have to provide a cash flow statement of held for sale. Cash used in operating activities, investing activities, financing activities. Because if the disposal group is maybe entire North Indian operations, the entire North Indian operations cash flow, you have to separate it. So the reader of the accounts knows that once this asset goes out, so much of my cash flow is going to be affected. This is a the cash flow of a held for sale is a very critical document. It gives the readers actually too much information. Now we come to the last part of today, which is discontinuing operations. So if you look at it, we have held for sale, which is one part, which is the balance sheet part. Now we come to discontinuing operations, which is basically the P&L part. Now what's the difference? As we discussed, as I told before, all held for sale are not discontinuing operations and vice versa. It may be not. That's the first thing we have to remember. Everything held for sale need not be discontinuing operations or vice versa. The reason behind it, we will have a look. Most important, where maximum mistakes happen in the India is definition of discontinuing operation. Everything sold is not a discontinuing operation. That's the first thing we have to learn. Lot of mistakes happen here. Discontinuing operation means it must be a separate major line of business or geographical area. Major line of business, material, large something, or geographical area like North India, South India, Europe, something. It is part of a single coordinated plan to dispose of a major line of business or a geographical area which you plan to dispose of. Or the last one, subsidiary acquired exclusively with a view to resale. So if you have a lot of, imagine I have shops all across India. I have 100 shops across India. 2 shops I'm selling. 2 shops I'm selling, the shops might be held for sale because when I have a sale contract with a buyer, sale to happen within 1 year, it comes under held for sale. But it is not a discontinuing operation because it is not a separate major line of business or geographical area. It is just 2 shops. So this definition is what we have seen the maximum errors come in. People just refuse to understand this definition. In our mind, anything sold is a discontinuing operation. No, it has to be major line of business or geographical area or subsidiary for resale. Nothing else. That's why I said a lot of things might be held for sale, but not discontinuing operation. Same thing, vice versa. Some things may be discontinuing operation, but not held for sale. Example, abandonment. I ran away from a war-torn country. I abandoned my asset. Abandonment is not held for sale. Depreciation continues. But abandonment is a discontinuing operation because I cannot operate there. So this is how we have to understand. Very, very important to note this so that the errors can be prevented. Discontinuing operation can be past, already I disposed of. So you will have a previous year impact, current year. I sold off last year, so you know the previous year things. Discontinued, held for sale for future. This is the difference between discontinuing operation and held for sale. Let's look at these 4 examples. Company MNO disposes of a component of the entity by selling the underlying assets. Component of the entity, meaning a large geographical area or a major line of business. So it is a held for sale as well as a discontinuing operation. Because the question itself says I am selling off a huge component, a major area of my business. Second, PQRS ceased activities, stop the activities that meet the definition of a discontinuing operation without selling any assets. Something like abandonment. I just stopped one factory, I just closed. Meaning it is not held for sale, but it is a discontinuing operation. STU ceases activities, the same thing, third one. Fourth one, BWX will sell or has sold assets that are within the scope of 105 but does not discontinue operations. Meaning, out of 100 shops, I sell one shop. It is not a geographical area or a significant line of business. I just sold one shop out of 100 shops. So it is not a discontinuing operation, but it is a held for sale. So very, very important to understand this terminology change between discontinuing operation and held for sale. Let's try this question. This question actually very, very important for students or readers of 105. And the biggest mistake in 105 discontinuing operation is solved by understanding this question. A retailer of food, like a food or a burger chain, decide to sell one of its outlets in Delhi. The outlet has 200 burger shops in New Delhi. One outlet is sold. Is it non-current asset held for sale and discontinuing operations? That is the question. Out of 200 outlets, one outlet I sold in Delhi. The answer is, it is a held for sale but not a discontinuing operation because it is only a disposal group. It is only one outlet. It is not a major line of business or geographical area. It's not a subsidiary with a view to resale. This is the most important thing to understand in discontinuing operations. Just because something is held for sale need not be discontinuing operations and vice versa. Regrouping, yes. Held for sale, we discussed in the balance sheet, you don't need to regroup or reclassify previous year. But discontinuing operations, you have to regroup previous year. Previous year you are continuing, current year you are discontinuing. So in the current year, previous year figure also must be regrouped to discontinuing. Then only same to same comparison can happen. Very important learning in this standard. Discontinuing operations, you have to reclassify previous year. Held for sale, no need to reclassify. An example of how discontinuing operations is disclosed. The first part is profit and loss from continuing operations. Then you will see discontinuing operations. Then you will see tax, discontinuing operation. So basically, profit and loss must be split into continuing operations and discontinuing operations. Tax also between continuing operations and discontinuing operations. That is separately disclosed. The same thing with OCI, leading to total comprehensive income also. So PNL should be split between continuing, discontinuing. OCI also between continuing and discontinuing. And lastly, EPS also. Basic and diluted EPS also from continuing operations and from discontinuing operation. Very, very important. Because the reader of the account needs to know, if I have discontinued operations, what is the impact on my earnings per share? So PNL has got huge disclosures. PNL from discontinuing operations, OCI from discontinuing operations, EPS, earnings per share from discontinuing operation. 3 disclosures coming in the PNL. You have to reclassify previous year also. Only then you will get a very good picture of continuing operations and discontinuing operations. Since in the PNL has got only consolidated or total lines, in the notes to accounts, you must present full scale PNL of your discontinuing operations in the PNL format, like revenue, expenses, split by split. So the reader of accounts will know that what exactly have you discontinued, what is the detailed PNL of that. You have to disclose. So you will have profit and loss from discontinuing operations as a total. So you can analyze and find out what is the line by line impact on P&L. As you are aware, now Ind AS 118 is expected from 2027. The P&L format is largely becoming like a cash flow statement. So once 118 comes in, Ind AS 1 will be replaced. Subsequently, in all the standards, you will have changes in the formatting. Yeah, we'll take up the questions now in a minute. As we discussed, there is a limited impact of comparative between Ind AS and AS. There is no accounting standard for held for sale. We only have discontinuing operations, but it is technically not really comparable. So it's not really worthwhile looking into it because Ind AS is pretty detailed and Ind AS brings in a comprehensive understanding of discontinuing operations. So there's not anything major to look into in terms of what is a comparating between AS 10Y. As we discussed, it is very detailed. It has got huge amount of principles and assigned to it, etc. So before we take questions, we will just recap shortly. 105 has got two parts: held for sale, discontinued operations. Held for sale means within 1 year, if the sale is going to happen, please reclassify items in balance sheet to a separate line called held for sale. The measurement will be cost or fair value less cost to dispose, whichever is lower. Sale has to happen within a year. There are exceptions to the rule. No need to reclassify previous year. Discontinued operations, only if a major line of business or geographical area is sold or a subsidiary is purchased for the purpose of resale, only then it is discontinued operation. So what is held for sale need not be discontinued and vice versa. Discontinued operations have detailed disclosures in P&L between P&L, OCI and earnings per share. Previous year figures have to be regrouped and reclassified. So that takes us to the end of our presentation. We will take up questions, if any, or any clarifications anybody wants before we close for today. Back to you, Bhavesh.
Yes, sir. There are some questions from the participants.
Yes, sir.
The question is that if a company decides to sell a functional machine and expect to complete the sale in the next financial year, how should it be presented at the reporting date?
Yes, if the condition is sale must be genuine, asset must be in saleable condition, directors must be have passed a resolution, and sale is reasonably perfect. In such a situation, in the balance sheet, that asset must be reclassified as held for sale below current assets and disclosed. The measurement would be cost, that is the book value, or fair value less cost to dispose, whichever is lower. Depreciation will stop from that date.
Okay.
That is the simple.
Yeah. Can a property currently undergoing renovation be classified as held for sale if the work is expected to finish in 2 months?
Well, that question is, there is no direct answer for that. It will depend upon circumstances. Technically speaking, no, because asset is not yet ready for sale because you need renovations to push up the price. But if the buyer and seller is already negotiated, price is ready, renovation is just for the routine wear and tear and some basic sprucing up, then it is okay. So there is no direct answer to this. Largely, what we need to understand is that is the asset ready to be sold? For minor issues, you can ignore, but if the renovation is material, then it is not a held for sale. You have to wait for 2 months, complete all the renovations, then put it into the market.
Okay. One more question is there. If machine
Yes,
is
sir.
abandoned because its
Yes.
use is banned by environmental authorities, can it
Correct.
be classified as held for sale?
Now, that very clearly the index has mentioned that no, abandonment is not, it's not held for sale. Abandoned means you continue to use it, depreciation is going on. It is just that you cannot touch the asset or go and use the asset. Life is going on, physical life goes on of the asset. So there is a depreciation because of time period. It is just that you cannot go to that country or you cannot enter that factory and use that machine. But assets abandoned are discontinuing operations, and in the P&L you have to disclose the impact of abandonment, depreciation impact, impairment impact. If there is any expenses or income out of that, we have to disclose.
So let me add something in this question, sir. Like if this machine is abandoned, no, I'm not using because it has been banned by the authority.
Yes.
Then should I provide the 100% impairment in the year in which it is banned?
Technically, the impairment law is Ind AS 36. So if I am no longer allowed to use that machine, that means technically under impairment, my value in use is zero.
Yes.
So value in use is zero means the impairment condition says that you have to impair it 100% under Ind AS 36, not as per Ind AS 105.
Okay.
So Ind AS 36 says that there are two conditions for valuing. One is a fair value which you get from the market, like you value the asset in the market. Two is value in use, for which you use a discounted cash flow. Now value in use here is zero, because technically I can no longer use it, nor can I sell it in market. So it is 100% impaired.
Correct.
Now, if I can get a buyer for that asset who's in another industry and who's allowed to use this machine, we don't know. In such a case, maybe we can use proper accounting for that. But that is also rare. If the regulatory ban is there, then nobody can use it technically.
Okay.
Yes.
Yeah, one more question, sir. Should a company continue to charge depreciation on plant and machinery that is classified as held for sale, but is still being used until the transaction is finalized?
No. Moment it is held for sale, we have to stop depreciation, because what is in held for sale, the amount you are putting in held for that at fair value largely would be the price you are getting for this machine. There will be a memorandum of understanding with the buyer or something says that approximately this is the selling price, approximately. So the fair value will largely correspond with the selling price. So if I provide depreciation again, it is meaningless. That's why it says, moment you put in held for sale, stop depreciation or amortization. So then it is at fair value or the sale price.
Okay. If a company decides to sell a business operation that represent a separate major geographical area, then how should its results be presented in the statement of profit and loss?
In the P&L, what happens? There are three conditions. If you sell a major line of your business, if you sell a particular geographical area of business, or if you're buying a subsidiary for resale, three conditions. Any of the three, if it is there, it is a discontinuing operation. In that case, in the P&L, the revenue and expense, tax and earnings per share of this particular deal must be disclosed separately in P&L as a discontinuing operation.
Okay. Yes, now there is one question related to the consolidation. Like there is one group is planning
Yes.
to sell a 60% stake in a subsidiary but retain the remaining 40%. This would be classified as an associate. Since we are only selling a portion, does this entire 100% of the subsidiary's assets and liabilities get classified as held for sale, or only the 60% portion we are actually offloading?
Now, in this, the interesting part is what you plan to sell is what goes into held for sale. So what you are not going to sell, that 40% is treated as a regular Ind AS 109. That is at cost or as per 109, whichever we can pick up, fair value, FET or FETPN. That is our choice for the 40%. Wherever there is a commitment to buy, for example, here it is said 60%, there is a commitment to buy shares of my subsidiary by somebody. Somebody is already agreed that, okay, I will buy. So sale transaction is ready for 60%. So I am only selling 60% of it. Now, when I sell the 60% of it, what happens in my CFS? Things will change because the subsidiary has become an associate. But that is as regards CFS is concerned. From 105 concept, what we have to say is that what I am planning to sell is what I should put as held for sale. And since it is a sale of subsidiary, it also falls into the line of discontinuing operations. So in my P&L, I will have share of profit of whatever, dividend or something what I get from subsidiary or something, whatever I'm getting into P&L, that will be disclosed as discontinuing operation.
Okay. So, sir, in SFS, I have shown
Yes.
that as my investment, that I
Yes.
was having 100%. Now I am planning to sell 60%. Then that
Yes.
investment also I should.
Investment. Then in the SFS, it will be the nomenclature will move from investment in subsidiary to investment in associates. I have to do equity accounting, meaning cost plus share of profit. So whatever I invested in associate, I have to fair value it, and the difference will go to P&L.
Okay. And what about that 60%? Can I show that as held for sale?
Yeah, that is definitely held for sale, 100%, because there is a confirmed transaction for it. That there is a contract that I'm going to sell it within. Only thing, it has to happen within a year. All those conditions has to be fulfilled. But remember one thing, that 60% technically, I'm just talking in a different way. It technically will not come under 105 because it's a financial asset. Now, if you look at it, this subsidiary sale actually falls under the definition of discontinuing operations because I am purchasing a subsidiary with a view to selling it. It is a discontinuing operation. Now, in this case, along with non-current assets, if it's a disposal group, only then it falls under the 105. Otherwise, 105 is purely restricted to EP, CWIP, work in progress, investment property. This financial asset is scoped out of 105.
So can I summarize like that? This will be for non-current assets which are tangible in nature.
Yes. Now, what happens is that is why I answered it in two parts.
Yes.
Technically speaking, what I will do, I will just in my presentation, I think I had shown a slide. Just give me a minute. I think I showed a slide on this. If I have it, I'll just show it again so that. I think I don't have it in my presentation. Just give me a second. I'm just checking.
Yeah.
I think don't have it in my presentation. But what happens is that non-current assets held for sale is largely only for non-current assets. The financial assets, etc., are scoped out. Are you able to hear?
Yes, sir. Yes, sir.
It's totally scoped out of this rule.
Okay.
Scoped out means if it is a financial asset, we have to follow the rules of what you would call it. You have to follow the rules of Ind AS 109, or you have to follow the rules of whichever Ind AS it is there.
Okay. So
now,
under the current tangible.
Now what happens? Now what happens is that if it's a disposal group.
Yes.
In a disposal group, what happens is that you will have current non-current assets as well as other financial assets, etc., etc. So in such a situation, that is what the example we showed.
Yeah.
I think better I will just put my this one. Uh, 1 second. Let me. Oh, I think they're sharing from there. Okay, once this is over, I think I can. If I can, is it possible I can share my slide here? Just a second. Yeah. So 1 second. I'll just share my presentation. In that, I'll just good that you open this point because this is a matter everywhere there is confusion. Just a minute, sir. I'm just opening my presentation. You're able to hear, sir?
Yeah, sir.
Yeah. I'm just opening. Just a second. Sorry, are you? I think it just 1 second. Just a minute. Yeah, I got it. I think this is this clear. Is this view coming in?
Yes, sir.
Yeah. So this is why this standard is a bit confusing because as per this standard, measurement provisions of Ind AS 105, meaning lower of carrying value or fair value less cost to disposal, does not apply to these Ind ASs: deferred tax, employee benefits, financial instruments, agriculture, insurance. So financial assets, subsidiaries comes under here. So what it says, measurement provisions. So if you have a subsidiary to be sold, you show it under held for sale, but use the 109 provision. Do not use the measurement provisions of 105, which is lower of carrying value or this. Because in many companies, when subsidiaries are being sold, like Infosys, we have an example somewhere, I think 2018, 19, 19, 20, I think. They had two subsidiaries which they wanted to sell. So they put it under held for sale. Later on, what happened was that somehow that sale didn't happen. So then they put it back. So what it says is that measurement provisions, if you are doing financial asset held for sale, then make sure that you are measuring it as per that particular Ind AS. No need to follow this Ind AS. This was scoped out. But when we are selling it as a disposal group, what happens? You will have non-current assets and current assets and liabilities, etc. So when you are doing disposal groups, I will just show you. Yeah, something like this it will be. When you have disposal groups, you will have goodwill, PPE, intangible, inventory, investments. So you will have non-current assets, financial assets, all kinds of assets in that, other assets also. So what we are trying to do here is that the non-current asset, goodwill, PPE, intangible, those kinds of things will be valued as per 105, which is book value or fair value, whichever is lower. While inventory, like investment in subsidiary, associate, joint venture, all those things will be disclosed as that whichever Ind AS they are following. They will not follow carrying value or fair value less cost to dispose. That's the only difference what I'm trying to say. So this Ind AS is largely for non-current assets held for sale. This measurement criteria. So if you are selling subsidiary, if you are selling other things, make sure that the valuation is done as per that particular Ind AS. That's the difference.
Correct, sir. Right.
And to understand this, once you sell a subsidiary and the sale doesn't happen and you want to put back, as I said, Infosys annual report is a good learning. Somewhere 18, 19, 19, somewhere that time, I think so. They had two subsidiaries they put for sale and bought back. And it's very nice. You can read through and, the full flow we can learn from that. What happened? Because then the valuation, everything changes. When you want to sell And when you take it back, because subsidiary would have a lot of things, not just investment. They would have computers. They will have maybe something else. PPE. So many things would be there in a subsidiary. So when you put all that into one line, and then when you want to sell it, so it's a very interesting process.
Correct, sir. Correct. Rightly explained. Our company just acquired a competitor. As a part of the deal, we took over the distribution center that we never intended to use. We plan to sell it within 3 months. Since we just bought it, do we first
Yeah.
record it under Ind AS 16 at cost and then immediately reclassify it? Or can we measure it at fair value, less cost to sell right from the acquisition date?
Sir, on the acquisition date, was it a decision that it is being purchased for sale? That is the only question I have to ask.
Yeah, it is on the date of acquisition only. They had planned to sell it within 3 months.
So they had purchased it basically with the intention to sell. Can we say that?
Yeah, correct.
Yeah. If the purchase was done with the intention to sell, what clearly says is that on the date itself, you have to show it as non-current assets held for sale and use this carrying value or fair value, whichever is less, even if that 1 year period is breached. Because we had purchased it with the intention of selling only. I had no intention of using it. So straight away on purchase itself, I am putting there is no depreciation because I'm purchasing it. I will do the fair value and keep it in my books. But the rest of the things I should have done, like what we discussed, you should have, the management should have taken a lot of decisions. The management should be interested in selling. All those kinds of things should be done.
Correct. When presenting a disposal group on the face of
Yeah.
the balance sheet, we have
Yeah.
several intercompany receivables and payable between the parent and the subsidiary being sold. Should the
Okay.
intra-group balance be eliminated before we show the total asset held for sale, or do we show the gross amount because the buyer will eventually settle them?
Okay. Now what I want to tell is that in the SFS, now there are two things, SFS and CFS. In CFS anyway, intercompany is eliminated. What we are selling is basically items in SFS, correct?
Correct.
So here, that is my issue, that I have something which I want to sell. Now the question, I think that's the question, right? What I understood, that question is like that.
Correct, sir. Correct.
That is, they have decided to sell something, and there also has some interbalances between related parties, correct?
Correct.
In the CFS element here, for example, I have a factory in Maharashtra, large factory, 1,000 crore factory is there. It has got receivables, payables, it has got bank loan, it has got current asset, financial asset, PPE, CW, everything. That entire factory I'm selling it to somebody as a held for sale. So in that factory, if there is a receivable from parent or if there is a payable to step down subsidiary, so what? It has to be paid because that is within that fair value calculation.
Correct.
Whatever is in that, it will be the best way to call it is CGU, cash generating unit. So whatever I can identify to that cash generating unit of Maharashtra, I will identify whether loan is given by me or from whichever party. So the buyer will come due the due diligence. He knows that so much receivable, so much payable, net is this. Based on that, he is working out fair value and he is paying me one lump sum, maybe 10 crores. Once I get the 10 crore, I am allocating it to all the asset. Either it can be slum sale or it can be item wise sale. It can be anything. So my point is that here, what is in that CGU is what we are disclosing in the balance sheet, in the notes. Like I have a 10 crore investment in Maharashtra, which I am putting held for sale. I'll work out fair value. So whatever liability is there in my balance sheet, it's shown as liability is held for sale. So that can include related party also. I don't think there is a need to net it off or think. I personally don't think there is any need because that is a liability to that C. Whatever I can allocate to the CGU, I will allocate
Okay.
that way. I think what I understood is this, what I feel.
Yes, sir. Yes, sir. Yeah, so last question is there for
Yes,
today.
sir.
We are closing down our retail division in South India, but keeping our retail division in North India. While it is a large region, it is not a separate line of business globally. Does this qualify as a discontinued operation or is it just a restructuring? And where exactly is the threshold for a separate major geographical area?
Correct. That's a very good point. Geographical area threshold, we can actually look at segment reporting to find an answer. India is 108.
Yeah.
How the CEO is reviewing the annual report. Is he looking at South India and North India as separately, or for him it is just India? And South India, as they are saying, it is a minor unit, nothing major.
Correct.
If South India is not a major thing, then it is not a discontinuing operation.
Okay.
It can be held for sale, but it is not a discontinuing operation. Because in discontinuing operation, it has to be clear that it has to be a major line of business or a major geographical area. Now, I have a small, some immaterial plant in South India which I am selling. It is just like selling one outlet of a burger chain. So we have to look at materiality here. If South India is material, then it is a held for sale and a discontinuing operation. If South India is not material, it is only held for sale, but it is not a discontinuing operation. That's why we discussed earlier that held for sale and discontinuing operation are not always complementary. Sometimes it is held for sale for the same thing. It is not a discontinuing operation. Sometimes it is a discontinuing operation for the same thing. It is not a held for sale. It can be mutual vice versa, and need not be vice versa also. So in this case, since the question itself says South India is not important, according to me, it will not satisfy discontinuing operation criteria, but it is a held for sale.
Okay. Great,
Right.
great, sir. You explained all the queries very patiently, and
Thank
I
you, sir.
hope all the participants would have got that complete level of satisfaction. But now, sir,
Yes.
one question from my side, like
Yes, sir.
this standard was there in our Indes era. Under accounting
Okay.
standard, we did not had this kind of classification as held for sale.
We
So,
don't. Yeah.
so over there also the things were happening in this pattern, no? But it was not been presented or
Yeah.
disclosed.
Yeah. Only the presentation we missed.
Yes.
And in the consolidation, we had an interesting thing in AS saying that
Yeah.
what you are buying for future sales, you don't need to consolidate. So it was watered down. AS was very watered down, and we could hide. Like as a CFO, I was very happy with AS because I don't need to disclose half the things. But as a CFO, when 105 comes, I have a problem because I'm telling in advance that I have a big sale planned, and fair value means everybody actually knows approximately what sale value I'm getting. So the market knows my figures. So if the sale is delayed for a very long time, other people can jeopardize the deal. So many things can happen. Even GST department can see and send notice. Somebody can send notice saying this is not the. It just unnecessarily triggers a lot of things. That's why I said this standard, according to me, is very tough and very painstaking, and we have to be very careful when we think how to disclose, what to disclose. Is it a non-current asset or a current asset? What valuation is coming?
Yes.
So, it has got a lot of inbuilt mechanism for many issues. So, how much ever we read the standard, more and more doubts come to our mind. Oh, what will we do in this? Because there is no clear direct directions or some experienced direction only is there.
Yeah, somewhat it plays a judgmental role also.
Yeah, it's a judgmental. Yeah, that is the word. Judgmental is correct word.
Yeah.
Correct.
And so in accounting standards, sir, do we had any kind of like a disclosure to be made in notes to accounts addressing that, no, that I have a block of assets where 3-4 assets are there which we are planning to sell, because the balance sheet does not give that transparency which this index is giving.
Correct. Absolutely right.
Do we had any disclosure in accounting standard related to that, sir?
Very little, no, held for sale, there is no disclosure,
No.
but only certain companies, listed companies at that time, out
Okay.
of, materiality, some people used to write in the notes something that there is some planned sale, but that also was very, very minimum.
Okay.
And most people said, why to disclose and give figure to competitor? Here, what happened? Competitor is also reading my figure.
Yes, correct, correct.
So this held for sale is a bit tricky one. And the worst thing is, after showing held for sale, if the sale doesn't happen, reversing that entry. That is the worst thing. It is a shame also, loss of face. I did all this, now I'm reversing everything. So it is not a very, according to me, this standard is a bit tricky and very dangerous. Meaning, you have to be very careful before you decide to use it in a particular way.
Yes, yes, yes. Correct, correct, sir.
Right.
So with this, no, sir, I hope all the questions that are been placed in the chat box are being addressed.
Yes, sir.
And I'm sure that all participants would have gained the valuable insights, that will help them in their professional practice, audit engagement, and financial reporting responsibilities. And I would also appreciate the one point that you have taken in detail about the abandonment. I hope many
Yes.
participants would
Yeah.
have would require to get a clear difference between held for sale and abandonment, and that
Yeah,
you
that is very important. Very important.
rightly catched in all aspect. Even I have also noted some of the points for my future reference that how abandonment should be applied.
Sir, that is very dangerous clause, sir,
Yes,
because we will get mistaken anytime.
yes, correct, correct. Yes, so
That is the whole problem there.
correct, correct. So before we conclude the today's session, I would like to leave
Yes.
everyone with a small thought on the financial reporting. That generally accounting standard Ind AS, we use the word called that this we apply for the transparency of the financial statement. So transparency in the financial reporting builds the trust, and trust is the foundation of the strong financial market. Our standard 105, it ensures that stakeholders are informed not only about what the company owns at present, but also about what it plans to dispose of and how it reshapes its futures. That is the way this standard is having an objective, which you, sir, have taken all the points with good examples, numbers, and I hope all would have got all the points which are very important related to this Ind AS 105.
Sir, one clarification more I want to make on that subsidiary,
Yeah.
because I got a question on my WhatsApp now from one of the, I think, listener that to clarify.
Okay.
Their question was, if a subsidiary is held for sale and we classify it as held for sale today, the sale is happening maybe after 1 year. So as of today, should you consolidate that subsidiary? One question I just got now.
Okay. Okay.
So I think that is something I have missed answering. So I will just answer that. Just because subsidiary is a held for sale and you are putting it as a held for sale, it's a disposal group. Subsidiary will have machinery, plant, so many things. So if you put it as a disposal group, maybe 60% is being planned for sale. For example, when you put it as a disposal group subsidiary, you still have to consolidate
Okay.
till the time actual sale happens.
Okay.
That is the logic. Because the entire thing will be, even though disclosed as a held for sale, it is still your subsidiary, because sale didn't happen. So
Correct.
one participant, I think, must have sent me WhatsApp. So I will just
As of
read
the
it.
last day of the reporting year, you still
Yes.
hold control.
Yeah, correct. Yes. That's because you have disclosed it here, held for sale, does it, nothing has happened. That's why the Infosys example I gave you, that two big subsidiaries of Infosys, they showed as held for sale. Later on, sale got cancelled. They put it back.
Correct.
So,
Correct.
it's a messy, it's a very messy thing actually.
Yes. A good question, sir. That also.
Yes, sir. Yes.
Yeah. So with this, we come to the end of today's webinar. And on behalf of the Institute of Chartered Accountant of India, I extend sincere thanks to our esteemed speaker, CA Vinod sir, for sharing their valuable knowledge. Gratitude to all participants for their active participation, and appreciation to the organizing team for successfully conducting this program. We hope to see you again in the future knowledge session organized by ICI. Thank you to everyone.
Thank you.
Thank you, sir.
Thank you.